I've taken over 10,000 trades and I've learned that 99% of the concepts are complete bullshit that does not work. However, there's one concept I still use after years of trading. It would be liquidity. So in this video, I'm going to explain what it is and how you can use it to become a profitable trader. Okay, so what actually is liquidity? We hear, all about it as if it's some sort of buzz term, but what actually is it? It's simply, and this is something for your notes, it's major highs and major lows on the higher time frames, right? That is the only thing we care about when it comes to liquidity. We don't care about a random high on the 5-minute or 1-minute chart. We only care about major highs and major lows on the higher time frames, right? And what you've got to do is you've got to ask yourself, where is the stop loss orders, right? Where would people, and by people we mean big institutions, put their stop loss orders? They're going to put it at major lows and at major highs, right? That is all we use liquidity for, right? We just use it to target stop loss orders. Right, liquidity gives you the direction. It doesn't give you an entry. It's not an entry pattern. It gives you the direction of the market. But here's the thing: once you've got the direction right, you're 90% of the way there. Because any entry pattern, EMA, moving average, VWAP, fair value gap, any entry pattern will work if you have the direction right. So liquidity is only used for the direction. Really important. That took me 4 years to realize that liquidity isn't used, for anything fancy. It's just used for your direction. So what you've got to do is you've got to get onto one of the higher time frames, and there's essentially 3 higher time frames you can use: the 4-hour, the daily, or the weekly. Now I use the 4-hour chart because it gives you so many targets and for liquidity, right? Here, and here, and so on and so forth, right? So you're going to get onto the 4-hour chart and you're going to ask yourself this question, and this question here made me profitable. When you get on the charts, and let's imagine you're on the charts at this point, you're going to ask yourself which high or low is price most likely to go for, right? Which high or low is price most likely to go for? Is price at this point right here, when you open the charts, is price likely to come all the way up here and take out this high here where people would have their stop loss orders? Is that likely, or is this more likely? Is price likely to come down here and take out this low here, right? Which one's more likely? Hopefully it's pretty obvious. We're going to go for this low, right? Very unlikely we're going to reverse all the way up and take out this high. So what does that actually mean? It means we're going to mark out this low, this low, and this is our liquidity, right? This is our liquidity or stop loss orders, whatever you want to call it, because the only reason these markets move is for money, right? Where's the money? And money is essentially stop loss orders. So these markets will only move for stop loss orders. So we have our liquidity, and what this does is it gives us the direction, right? So let me ask you this. At this point here, would we be bullish or bearish? Right, if we're going to target this low, would we be bullish or bearish? When we get onto the 5-minute or whatever time frame we use, will we look for longs or shorts? Right, hopefully, it's pretty obvious we're going to look for shorts, right? We're going to look for any reason to get short and ride price down to this low. Right, we're going to look for any reason to target this low here. We're going to look for any entry pattern that's bearish, and we're going to ignore every single bullish entry. Right, if you just ignore every single bullish entry and only target a higher time frame liquidity, your win rate will go up massively. And that right there is what made me profitable. So let's get onto the 5-minute chart and look for some simple entries. Okay, so here we are on the 5-minute chart, and if you remember, I said we use liquidity for our direction, for our target. So hopefully it's pretty obvious price wants to take out this low here, right? We just want to get short. We're going to ignore every bullish fair value gap, any bullish sign in price action. We only want to look to go short. Now, if you remember in the previous bit, I said liquidity is what made me profitable. Kind of, right? There's 2 parts to liquidity, which I didn't realize until my 3rd or 4th year in trading, which is there's the liquidity, which I just talked about, right? So major highs, major lows on the higher time frames. What smart money's looking at, that gives you the direction. That shows you where price wants to move. But that alone is not enough to make money, right? In trading, we don't just guess where price goes. And we don't make money by guessing where price goes. We make money by actually getting a good entry and, exiting at a good price. Right, so in order to become profitable using liquidity or any strategy is you need to wait for something called a liquidity sweep. Now, what that is, it's a stop run, right? So what a stop run is, and the difference between a stop run and, liquidity in general, is this is a major high where there's billions of dollars, right, on the 4-hour chart, whereas a stop run is just a quick little move, right? A quick little move designed to take out stop loss orders before price drops off, gives everyone, all smart money traders a high probability retracement to enter on, and then targets this low, right? That is what a stop run actually is. So if we look at this high here, now remember, the only reason liquidity sweeps work is if you have the direction, right? And we get the direction using liquidity on the higher time frames. But once you've got your direction, now you need your stop run, you need your liquidity sweep. So can you see this high here? There are people who, I'm going to zoom all the way out, right, who've trailed their stop loss here, and here, right? There are people who are just trailing their stop loss orders all the way down. So there's liquidity, right? There's a tiny bit of liquidity compared to this. There's some stop loss orders at this high here, right? So what price does, you notice price comes up, and remember we're bearish, right? So price comes up, wicks out, takes out this high here. Anyone who had their stop loss orders is taken out. Price drops, gives everyone in the know high probability entry here because we've had our liquidity sweep, and then it drops. Probably going to keep going and take out this low here, right? And you'll see this entry pattern over and over and over again in trading, right? Higher time frame liquidity sweep on your entry time frame, and then you enter for your trade. So what does this actually look like? Let's clear this blue line like this. So this right here, this is your liquidity sweep. You have to wait for this. You need to wait for this, right? Because for 4 years I made no money in trading because I could get the direction right, but I didn't wait for a liquidity sweep. So what would happen is I would, sell at this order block here, knowing that we're bearish and I'm going to target this low, only to see price come up, take out my stop loss here. I thought this order block would be safe, takes out my stop loss, and then goes straight to take profit. And it's the most annoying thing in the world. So if you ever, if you're ever in a situation where you get the direction right, but you keep on losing, price hits your stop loss and goes straight to your take profit, it's because of this, right? So this is our liquidity sweep, which is simply a stop run. Right, so we've got our liquidity sweep, which is the most important part. Once we've got our liquidity sweep, then and only then do we look for our entries. Now, I'm going to say something that's a bit controversial, but trust me, after years of trading, this is very, very true. Once you have these two things, so you've got the direction using liquidity, and you've got the liquidity sweep, the entry pattern is the least important thing. I cannot stress this enough. It doesn't matter, hey Atif, try enter on a mitigation block, inversion fair value gap. Does not matter. If you have liquidity and the sweep, any entry is high probability. So let's just get some easy entries here. We've got a fair value gap between these two candles here, like that. This can be your entry, like this. You're going to put your stop always at the liquidity sweep high. Super important. There is no point, there is no reason waiting for liquidity sweep if you're not going to put your stop loss at the high or low that form the sweep, right? This high here form the sweep. Your stop loss has to be at this high here. Now, if you want to finesse your entry, you want a super high win rate, you can get on the 1 minute chart and look for some sort of, fair value gap all the way up here. But your stop loss has to be fixed at this point, right? It doesn't matter where you enter, but your stop loss has to be fixed at this high. You can never be, oh yeah, I'm just gonna move my stop loss here. You can never do that. It has to be fixed at this high. Otherwise, this strategy will not work, right? And in fact, what will happen is price will come up, it will literally poke out your stop loss and then go straight off without you, right? So you don't need tight entries, you don't need perfection, you just need consistency. Super important there. So your stop loss is fixed at this high, right? Fixed at this high, and then for your entry, if you're a day trader or scalper, aim for a 2 or 3 risk to reward ratio, right? So you can aim for a 2 to 1, which is easy. I always aim for a 3 to 1. And if you really want to, you can target this liquidity pool right down here. Now, this is really important. Let's say, let me just zoom out all the way up here. Let's just say you entered here, right? Or, I don't know, you entered let's say on this like fair value gap order block. You don't have to target this liquidity pool on the 4-hour chart, right? You don't have to have your entry. Let's say you do something like this. You don't have to have your entry like this with your take profit all the way down here, right? Because it's very likely if you're a day trader or scalper, that price could do this and then start to reverse, right? It will give you a 3 to 1 here and then consolidate all the way up until the next day. Here's your liquidity sweep of all these highs, and then continue upwards and then consolidate some more, right? So you don't have to do that intraday, right? You don't have to target the major liquidity pool. All you need to do is aim for a 2 or 3 risk to reward ratio in that direction, right? So, but for me, simple, 3 risk to rewards all you need. The entry pattern does not matter. If you like indicators, if you like optimal trade entry, Fibonacci, order blocks, and inversion fair value gaps, whatever you like, use it once you have liquidity that gives you the direction and you've got your liquidity sweep. Now, it's all well and good having the best entry, but if you don't have the right mindset, you're never going to make money. So make sure you watch this full trading psychology video on screen now. And if you want me to personally teach you, review your trades, all that good stuff, you want hour-long lectures, and you want the PDF to this actual liquidity sweep model, make sure you check out the link in the description below. 50% off until the end of the month. And other than that, I'll see you in the next video. Peace.